Let me paint a picture. It's 9:45 a.m. New York time. The market just opened. You've been watching a stock. Maybe Tesla, maybe Apple. Doesn't even matter. You see a clean setup. Nice breakout forming. Volume picking up. You take the trade. You feel good about it. You place your stop loss right below the recent low because that's what you've been taught. And then price dips just enough, takes your stop out perfectly, and then, without hesitation, reverses and runs exactly in your direction. And you're sitting there like, seriously? Again? If that sounds familiar, this video is going to hit home because what you're experiencing is not random and it's definitely not bad luck. By the end of this video, you're going to understand why your stops keep getting hit, what the market is actually doing around those levels, and how to place stops in a way that stops you from getting shaken out constantly. And no, this isn't about some magical indicator. This is about understanding how the market actually moves. Let's start with the mistake, because almost everyone makes the same one. Most traders place their stop loss based on what looks clean. You've probably done this. Right below a recent low, right above a recent high, just under support, just over resistance. It feels logical. It feels safe. It feels like you're being disciplined. But here's the problem. If it looks obvious to you, it's obvious to everyone else too. And when a level is obvious, it becomes crowded. Let's take a real-world style example. Think about the S&P 500. It's one of the most traded instruments in the U.S. Now imagine this. SPY is pushing up toward a previous high from earlier in the day. Traders all across the country are watching the same level. You've got day traders in New York, retail traders at home, prop firms, algorithms. Everyone sees that level. Now what happens? A breakout forms. People start buying. And where do they put their stops? Right below that breakout level. Same spot, over and over again. Now you've got thousands of stop losses sitting in one area. That's not just a level anymore. That's a liquidity pool. This is the part most traders don't fully understand. The market runs on liquidity, not opinions. Not predictions, not indicators, liquidity. And here's what that means in plain English. For large players to enter or exit positions, they need orders on the other side. They need buyers and sellers. Now think about stop losses. A stop loss isn't just a risk control tool. When it gets triggered, it becomes a market order, which means your stop loss is actually fuel for the market. Think of it like this. Imagine a crowded parking lot during Black Friday in the US. Everyone is trying to get in at the same time. If you're a big truck trying to move through that space, you're going to go where the space opens up. In the market, stop losses create that open space. So price naturally moves toward areas where orders are stacked. Let's talk about Tesla. Tesla is known for sharp moves and fake-outs. Let's say Tesla breaks above a resistance level at $250. Traders jump in. Momentum traders, breakout traders, retail traders, everyone piles in. Now, where are the stops? Usually right below $250. Now, watch what often happens. Price breaks out, then dips back below $250, stops everyone out, and then rockets to $260, $265 without them. Was that manipulation? Not really. That dip just collected liquidity. Here's why this messes with your head. Because it feels targeted. It feels like the market is literally taking my stop and reversing. But zoom out. The market doesn't know you exist. It's reacting to clusters of orders. And if your stop is in the same place as thousands of others, you're part of that cluster. There are certain areas where this happens again and again. If you're placing stops in these spots, you're vulnerable. Equal highs and equal lows. Previous day high or low, pre-market high or low, round numbers like 100, 200, 250, clean support and resistance levels. These are not safe zones. They are target zones. Take Apple. Let's say Apple is trading around $180. It forms a clean double bottom. Every trader sees it. people go long. Stops go right below that double bottom. Now, price dips slightly below, takes those stops, and then rallies. That move below the low, that's a liquidity sweep. This is where you need to change your mindset. Stop thinking, where should I put my stop so I don't lose money? Start thinking, where is my idea actually wrong? Those are two completely different questions. Let's get practical. Here's what actually works better. 1. Stop using pretty levels. If your stop looks clean and obvious, it's probably in danger. The market doesn't respect nice-looking levels. 2. Give your trade breathing room. Price doesn't move in straight lines. There's noise. There are wicks. There are sweeps. If your stop is too tight, you're getting taken out by normal movement. Place stops beyond liquidity zones. Instead of placing your stop at the level, place it where the move would actually break your idea. That usually means slightly beyond the obvious level. 4. Watch for sweeps before entries. Instead of entering the breakout immediately, wait. See if price sweeps the level first. If it does, and then reclaims it, that's often a stronger entry. 5. Use higher time frames. This is huge. What looks like a strong level on the 1-minute chart might mean nothing on the 1 hour. Always zoom out. Let's be real for a second. Even if you do everything right, you will still get stopped out. That's part of trading. The goal is not to avoid losses. The goal is to avoid unnecessary losses. There's a difference.
Once you understand liquidity, something changes. You stop reacting emotionally. You start anticipating behavior. You start seeing why price moves the way it does. And those random stop-outs, they don't feel random anymore.
So here's the truth. Your stop loss isn't getting hunted because you're unlucky. It's getting hit because you're placing it in obvious locations. Those locations are full of liquidity, and the market naturally moves toward liquidity before making bigger moves. Next time you're about to place a trade, pause for a second. Look at your stop and ask yourself, if I were the market, would I go there first? Because most of the time, the answer is yes. And once you start thinking like that, you stop trading like the crowd.